3 years after interest rates began to spike, the first light of a new real estate cycle is clearly visible on the horizon. In LaSalle's ISA Outlook 2025, we look at how to make the most of this new dawn. I'm here with my colleague Eduardo Gorab, and we're going to walk through highlights of the 4 global themes of the report. As always, if you want to go deeper, have a look at the full report on the Insights page of LaSalle.com. Ed, over to you to cover the macro context around why we see the dawn of a new cycle.
The idea behind this new dawn is renewed certainty around the direction for global interest rates. Now, the balance of evidence now tilts towards there being more signals that inflation is coming under control. And based on this evidence, we have seen many central banks begin to cut policy rates. Longer-term market rates, however, have been moving less. And corporate bonds, our preferred measure to consider pricing in real estate markets, have been on a gentle but downward path, particularly as credit spreads ease, all of which pointing to a fairly healthy real economy. While these points are all encouraging, it is important to recognize that no two cycles are quite the same. For example, central banks are not likely to go quite as far in this easing cycle than they did during the GFC or after COVID. So if no two cycles are quite the same, the shape of this cycle remains uncertain. The signs are out there, but how to interpret them can be complex. There is an old mariner's rhyme that encapsulates this idea pretty well. Red sky at night, sailors delight. Red sky at morning, sailors take warning. There are good reasons to think that the current red skies are a good omen. Taking a quick temperature check of the world economy, inflation is cooling, GDP growth is expected to be steady, albeit muted. But equally, there are some signs that the red skies could be a warning. For example, China and its residential market are a notable soft spot for the world economy. And in addition, uncertainty remains high electorally and geopolitically too. So how can investors prepare for the various combinations of growth and interest rate environments that the future could hold? The answer to that question really hinges on how sensitive parts of investors' portfolio are to these 2 key driving forces, growth and interest rates. We have developed a framework which focuses on measuring the sensitivities of, firstly, real estate cash flows to the strength or weakness of the economy, we call this beta, and capital values to interest rate movements, or duration. So plotting these two in a 2-dimensional space renders 4 quadrants, each with characteristics based on their behavior. We group rate-led markets, which are more responsive to interest rates than growth. These are often low-yielding markets like residential in Germany or logistics and offices in Japan. And we could see these benefit from a weakening in the world economy. For one, they are less responsive to growth, or lack thereof, but they also could respond sharply and positively to lower rates. Growth-led markets are the reverse, displaying more sensitivity to growth than rates. These tend to be especially demand-sensitive, like hotels, for example. Reactive markets are sensitive to both. Examples of these could include some logistics markets in Australia. German and Japanese offices would also fall into this category. And finally, stable markets are those that are typically insensitive to both. And although rare, some examples could include pockets of niche property types, particularly in the US. It would be wildly impractical to try to reposition an investor's portfolio based on every twist and turn of the macroeconomic narrative. Instead, we advocate for building portfolios with an awareness to beta and duration characteristics of each of its components. Now, Brian, over to you to discuss how this is translating into capital markets.
Thanks, Ed. So our second theme is curing the capital stack hangover. Some investors are dealing with some bad headaches as they face this new dawn. First, the good news. Greater clarity on the direction of interest rates should help drive a healing of the capital markets. Reduced uncertainty could help lenders re-enter the market as confidence in their existing loan books increases. Parts of the market which had been essentially shut down, like CMBS in the US, have already come back to life, and debt is becoming accretive again in more sectors and markets. That said, transaction volumes, a backward-looking indicator of activity, do not yet show much evidence of a recovery. Global deal volumes are roughly flat compared to last year. But more forward-looking indicators are starting to turn positive. For example, surveys of global real estate sentiment are gradually improving. Our colleagues at JLL, who have a large proprietary data set on bidding trends, are seeing more bidders on deals and narrowing bid-ask spreads. The bad news is that interest rates alone are unlikely to be sufficient to bail out many legacy deals. That's because we do not expect rates to fall sharply, as Ed has said. Luckily, distress remains fairly limited compared to prior crises like the GFC. Tracking of newly distressed assets by MSCI suggests that global levels of stress are higher than they have been for some time, but remain relatively muted. And the sector breakout of that distress is telling. Distress in the GFC was broadly distributed. During the pandemic, it was concentrated in COVID-hit sectors like hotels and retail, while it remained nearly non-existent in industrial. Recently, though, offices and apartments have accounted for the largest shares of newly distressed assets. The office sector challenges, those are widely known, and we'll talk about that in a bit. But the apartment observation may seem surprising. It mostly reflects over-leveraged deals and softer NOI in the US, where conditions have cooled in multifamily substantially, and also Germany, where regulation has limited the ability to pass inflation through to rents. With relatively contained stress, we do not see a blanket opportunity to take advantage of distress at scale. We do anticipate situation-specific opportunities. For example, mezzanine and preferred structures can be ways to solve capital stack issues and achieve attractive risk-adjusted returns without taking on full equity risk. It's also possible to buy high LTV loans at a discount or capitalize on the issues faced by developers who have been particularly strained. There's also a chance to identify assets with operational low-hanging fruit, such as where capital is needed to complete important things like leasing and refurbishments. And there are also cases where issues like fund life expirations are making motivated sellers. These situational opportunities are just one part of the investable option set. Ed, over to you to comment on how we make sense of this broader, increasingly complex investment menu.
Yeah, making sense of the menu faced by investors might feel like a pretty daunting task. For one thing, the menu is long. It's long because specialty sectors and subsectors have multiplied. But not only is the menu long, but it's also more complex. More characteristics in simple sector and location are likely to drive relative outperformance. And to make things even harder, the menu is ever changing. When we look at vacancy rates, we see a very diverse mix. Some sectors remain very tight, while others are still very weak. This has not really changed in our recent publications. Quality divides within sectors also continue to mark a significant difference. Think about building quality, sustainability credentials, amenity offering, micro-locations, and sub-market vibrancy. What has changed here is that pricing dynamics within these quality divides has started to create some attractive entry points. We are still working through a wave of new supply in many of the strongest sectors over the last few years. Brian's already mentioned this. With starts falling rapidly, though, we think that this wave is starting to subside. And office markets are still all over the map. What has changed is a degree of adjustment in capital values across office markets. And finally, after a long time off the menu, we are finding room for repositioned retail once more. Now, one way to make decisions when faced with a long, complex, and changing menu is just to order the usual. In this context, that would really mean ordering the usual of logistics and residential. But we think that there are reasons to believe we might be entering a period where less consistent relative sector performance. The recent period of dominance by the same sectors, again, logistics and residential, has been abnormally long, and theory suggests that markets tend to adjust. We have already seen big moves in capital values and overbuilding in some of the formerly strongest sectors. Now, our preferred way to deal with this large, complex, and evolving menu is using a fair value approach. At its very core, these approaches compare the returns on offer in the market against the returns an investor should achieve to be compensated for the risks that they take on. Now, this type of framework is particularly helpful when portfolios have a wider set of options. Specialist portfolios that have severe constraints on sector or geography might not have the ability to invest into all parts of the market that show attractive value. By contrast, diverse portfolios retain the opportunity to veer towards parts of the menu that might look more appealing. Brian, how does timing fit into all of this?
The English proverb, "the early bird catches the worm," can be traced to the early 17th century. Real estate data don't go back nearly that far, but its much shorter history suggests a similar observation can be made about real estate cycles. The early in the cycle investor is likely to see attractive investment performance. Our analysis shows that funds that had their first close in the early stage of a recovery substantially outperformed the broader market. But there's still many choices to be made about where and how that early bird should look for the worm, as Ed has said. Each year, we summarize our investment recommendations for the coming year in a table, and here's this year's table. You'll see it's a bigger list than last year, reflecting today's broadly favorable bottom position in the cycle. So a few notes on the recommendations this year. The long-term tailwinds for logistics and living sectors remain intact, even if supply is impacting short-term prospects in many parts of the market. Retail is back on the investment menu in a big way, as Ed said. The investability of even the office sector is increasing from a low base, owing to stabilizing occupational fortunes and rebased pricing. We see a broadening opportunity in selectively providing new capital to strong development projects and debt strategies. Those remain attractive. We continue to advocate for integrating physical climate risk into strategy, and that's a view only reinforced by recent disasters like Hurricanes Helene and Milton. We also see select brown to green opportunities in getting ahead of market and regulatory changes. REITs appear well positioned as signals point to a potentially strong run. Finally, the changing definition of core real estate creates opportunities to manufacture new core stock and reposition portfolios to have greater exposure to those new economy sectors. So in summary, a new real estate cycle is dawning, but it is essential to avoid overconfidence and remain realistic. There are a range of risks on the horizon that require monitoring. In addition, investors should not expect a rapid decline in interest rates or for them to again reach ultra-low levels. And yet, it's good to be the early bird. History has shown that investing early in a cycle tends to lead to relatively strong performance. For a deeper discussion of all these trends, check out the full version of the report, as well as the regional chapters, which we will release over the coming weeks. We'll start with the Europe chapter in about 2 weeks' time. We hope you continue to watch and read.